There are two ratios related to accounts receivable efficiency: the accounts receivable turnover ratio and the accounts receivable days ratio. The receivable turnover ratio is calculated by taking revenue and dividing it by the accounts receivable ending balance or the accounts receivable average balance on the balance sheet. A higher accounts receivable turnover ratio means a company receives payment for revenue more quickly, and a lower accounts receivable turnover ratio means it's paid more slowly. If the receivables turnover ratio is low, it could mean a few things. It could mean that the company is extending too much credit to its customers. It could also mean that it's operating in an industry where the customers typically take a long time to pay. All else being equal, a higher accounts receivable turnover ratio is better than a lower one. Now let's look at the accounts receivable days ratio. This time, instead of looking at the number of times that accounts receivable turns over in a year, we're going to look at the average number of days it takes for that inventory to turn over. So the formula here to calculate this is equal to the accounts receivable balance on the balance sheet, either the ending period or the average of the last two periods, multiplied by 365 days, or however many days are in the period, and then divided by sales. The result from this calculation will be the average number of days that it takes for a company to receive payment for the sales that it's made. All else being equal, a low number of receivable days is better than a high number.